If you only watch one investing video, make it this one. Today, I will show you 2 proven facts why ETFs are perfect for beginners and 10 key metrics I look for when choosing the right one. Stay until the end because I will review when is the best time to start buying them. For beginners, buying individual stocks is just gambling. You are competing against professional institutions with advanced software and armies of analysts working 24 hours. You have a day job and a life. You don't have time to compete with them. Now you are thinking just put all your money into the biggest winners. But look at the history. The market leaders of the past are different from today. Mega companies always fall off the charts and get replaced. If you're unsure about picking a good individual stock, ETF can be a good alternative. Look at the professionals. Data from the S&P Global shows that in the past 15 years, 90% of actively managed funds where professionals pick stocks for you still lose to a broad index fund, which simply follows the overall market. Therefore, the odds of you picking the exact next few stocks to carry the entire stock market for the next 20 years is incredibly low. So instead, use an ETF, an exchange-traded fund. Instead of buying one stock, an ETF lets you buy a tiny slice of hundreds of companies all at once, wrapped into a single basket. The legendary founder of Vanguard, John Bogle, said, "Don't look for the needle in the haystack, just buy the haystack." When you buy a broad index fund, you own the haystack. If a company falls, the index automatically replaces it with the next rising star. However, according to JP Morgan, there are over 12,000 ETF listed globally. Therefore, beginners are overwhelmed. Don't worry, today I will be using the Moomoo app to help you find the best ETFs for you. They have a comprehensive set of tools. Everything you need is right in the app. Even though they sponsor this video, the opinions I share are entirely my own. Moomoo is running a promotion. If you deposit $3,000, you could get $80 of cash, coupons, and Nvidia stocks. That is a 2.7% return. But if you bump up your deposit to $10,000, your total reward can be up to $300. Now that is a solid 3% return on your money that you haven't even invested. If you are interested, scan my QR code or use the link in the description. Now this is important. Follow the on-screen instructions because once you sign up, you must use my special code Skyler88 when you make your first deposit to unlock the full reward. The promotion will not last forever, so sign up now before it ends. I may earn a small commission at no extra cost to you. Alright, let's start with picking the right ETFs for you. On Moomoo app, navigate to the markets. At the top, go to ETFs. Here, you can choose by country, US, Singapore, or Hong Kong. Below, you can see different types of ETFs like index ETFs or thematic ETFs, which includes energy, gold, silver, US Treasury bonds, high dividends, and more. Many investors start by building a foundation with broad index fund. In fact, for a lot of people like myself included, it is the only type of ETF they ever hold. Press Index ETFs and you will see a list of them sorted by popularity. If you slide to the left, you can see its key metrics like share price, volume, returns, asset under management, expense ratio, and more. I will explain some of this later. If you want to compare different ETFs side by side, click on the VS icon on the top left and take the ETFs you want to compare. In this demo, I will compare SPY and QQQ. The SPY tracks the S&P 500 index, the 500 largest US companies. It is the ultimate benchmark for the US stock market. When people talk about the market, they refer to the S&P 500 index. The QQQ tracks the Nasdaq 100, the 100 largest non-financial stocks dominated by technology companies. So I tick them and press the compare button. On the next page, I am also going to add a popular world ETF, the Vanguard Total World ETF, which includes the US plus the rest of the world. So I press the plus button and search for VT. Hit the plus button beside VT and hit confirm. Here you can see the 3 ETFs past performance on a chart. You can change the time frame on top. I will use the 10-year in this example. If you press and hold on the chart, you can see the returns as you slide your finger across the timeline. Underneath the chart, you can see all kinds of metrics. For first-time ETF investor, it is like looking at the instruments of an aircraft. Don't worry, I will show you the 10 metrics I look for when choosing the right ETF. Stay until the end because number 10 is a powerful metric nobody talks about. The first metric is holdings, industry, and regions. This is one of the most, if not the most important metrics. While the number of holdings tells you how many companies are inside a fund, you must look deeper to understand where your money actually goes. For example, SPY and QQQ. These are strictly US-focused funds entirely in the United States. Furthermore, if you look at the industry breakdown, QQQ has almost 60% concentrated in technology stocks. A lot of beginners add QQQ when they already hold SPY, thinking they are more diversified. Instead, they are even more concentrated in technology stocks. VT takes a different approach by being a true global fund that spreads your risk across the entire world. If you look at its regional breakdown, about 60% is in the US, while the rest is Europe, Pacific, and Asia. Technology is just around 28%, spreading the rest of your investment across a wide mix of other industries. If you want a more detailed breakdown of each ETF, just click on the ETF title you want to see. On the ETF main page, go to Fund. Scroll down and you will see Holdings, Asset Breakdown, Sectors, and Regions. Here, you will see the complete composition of the ETF presented neatly. The second metric is called volume. You can press the small volume word and it will show you a graph. Volume represents the number of shares being bought and sold daily. You want high volume because it guarantees a crowded, highly liquid marketplace. This ensures that you can buy or sell your ETF instantly at any time without delays or paying a premium. As a rule of thumb, if an ETF is trading under 500,000 shares a day, it is considered low volume and should be approached with caution. The third metric is the 10-year annualized return. This is the most interesting metric, but you shouldn't just look at this metric in isolation. In the past 10 years, QQQ has beaten the SPY and VT because the AI tech stocks have been exploding. But remember, past performance is not guaranteed of future returns. An ETF that performed well in the past doesn't mean it can continue to do the same. But it also doesn't mean it will not continue like this. The fourth metric is the Morningstar rating. This is a premium feature that is free on Moomoo. Instead of chasing a fund that simply had a lucky streak last year, the Morningstar rating judges a fund across a full decade, grading it against similar funds. It accounts for high fees and market swings. A 4 or 5 star rating means the fund has a proven track record of keeping costs low and protecting investors during market crashes. The fifth metric is the issuer. The issuer is the company running the ETF behind the scenes. For a long-term portfolio, you want massive fund managers with long histories and excellent reputation. Spider by State Street runs the SPY, the oldest US ETF in history. Invesco runs the QQQ. Vanguard is founded by John Bogle, the godfather of index investing. There is also iShares by BlackRock, the largest asset manager in the world. If you have watched this video so far, save this video because I'm sure you will come back to this through all your investing journey. The sixth metric is the asset under management. The AUM tells you exactly how much investor money the fund is currently handling. Larger funds are generally much safer. You should target funds with an AUM greater than $1 billion to avoid liquidation risk, which is when a small fund closes down because it is not profitable. The seventh metric is the expense ratio. I am obsessed with this metric. The expense ratio is how much the fund charges you per year based on how much you invest. For example, a 0.2% expense ratio means that for every $1,000 invested, you pay $2 a year. It has a massive impact on your returns. For example, invest $1,000 a month for 30 years, a fund charging 0.03% versus 0.3%. That small differences save you over $70,000. If two funds are equal in every other way, always pick the one with the lower fee. The eighth metric is the management style. As a long-term index investor, you want passive management. Passive funds simply invest in all the companies listed in the index without a fund manager trying to identify which individual stocks will win big. The ninth metric is the benchmark. The benchmark is simply the index the fund is copying. We call it tracking. For example, the SPY benchmark is the S&P 500 index. Other popular benchmarks you should be familiar with are the FTSE All World Index, MSCI All Country Index, and the Singapore Straits Times Index. The last metric is the equity style box. This is one a lot of beginners ignore. If you are browsing ETF individually, you will see a 3x3 grid called the equity style box. It allows you to see the size of the companies, large, middle, small, and the investment category, value, blend, growth at a single glance. For instance, the SPY is large blend, a mix of massive value and growth giants. The QQQ sits as a large growth. Some beginners add QQQ to SPY. What they are actually doing is concentrating their money into large growth companies thinking they are more diversified. Use this grid to check if you are buying multiple ETFs that invest in the same category. By the way, for beginners, I understand that there are too many different investing videos out there. You can also use Moomoo AI to help you do the summary on this metric to choose the best ETF. This directly addresses one of the most common pain points for retail investors: the gap between the volume of market information available and the analytical capability to make sense of it. With Moomoo AI, investors no longer need to spend hours reading research reports or seeking professional advice for every investment question. They have a knowledgeable, always available assistant built into the same platform where they trade. To access Moomoo AI, simply open the app and tap the AI assistance icon on the home screen. If you like this video, subscribe now because I have many more beginners-friendly videos to help you cut through the noise and focus on investing the right way. Once you have chosen the right ETFs, the next question every beginner asks is, when is the right time to buy? Should I jump in now or wait for a drop? Statistically, lump sum investing, meaning you deploy 100% of your available cash into the market right now, tends to give the best return. Why? Because the stock market goes up about 70% of the time. History has shown again and again that timing the exact bottom of the market is impossible. But what if you don't have a giant pile of cash sitting around? What if you are investing out of your monthly salary? Personally, the day my salary arrives, I set some money aside and drop it all into the market immediately. On a micro level, that is lump sum investing because I'm putting 100% of my cash to work on day one. But because I repeat this process every single month, it becomes dollar cost averaging, or DCA. DCA is the ultimate stress-free strategy to deploy your money. You commit to investing a fixed amount, say $500, on the exact same day every single month, completely ignoring what the stock market is doing. When the market is up and expensive, your $500 naturally buys fewer shares. But when the market crashes and go on a sale, your $500 automatically buy more shares. Over time, this strategy averages out the ups and downs of the market, ensuring you end up paying a very fair price for your ETFs. If you want to learn more about why DCA is a good investing strategy, watch my previous video, DCA versus buying the dip, where I show you a study where 5 different investors deploy their money using 5 different strategies. I have put the link in the description. The results will surprise you. The best part about DCA is you don't even have to do this manually. Everyone I know of automate DCA using the regular savings plan, or RSP, so your money get invested in the background while you focus on living your life. This can be set up in just 1 minute. Open the Moomoo app, go to the Market tab. On the top, click US. In the middle, press RSP. On the next page, press Create Plan. Enter the symbol of the ETF, for example, SPY for Spider S&P 500 ETF. Key in your investment amount, for example, $300. Choose the frequency, for example, monthly. Press Buy and then confirm. In 1 minute, you have just automated the most important step in your financial life. You can set up the RSP with as low as $5. Moomoo provides automatic conversion from SGD to USD when you link your RSP direct to your bank account. Moomoo Singapore offers permanently $0 commission on US stock trades. US stock trades are subjected to a platform fee of 0.0049 per share, or a minimum 99 cents per order. Now that you have picked the right ETFs and automated your investment, what if I tell you that that was actually the easy part? The hardest part of investing is staying calm and disciplined when the market gets choppy. Staying invested is always easier said than done. According to the MarketWise studies, 43% of investors admit emotion hurts their performance. 42% says fear of missing out affects their investment decisions. The best strategy in the world is useless if you panic sell at the wrong time. This is why financial literacy is so important. If you want evidence and data-backed investing videos to help you cut through the noise and stay focused, hit the subscribe button now. And don't forget to use my link in the description to get your $300 reward.